Hello everyone, I'm Dave, and with me here in my group are Akhil, Jiao, Kangjo, Havishwa, and Ceci. Today, we would like to walk you through a significant event that has impacted the accounting and consulting industry in Australia, the PwC Tax Scandal. To help you understand what happened, we have a short video to explain this ethical case study. The story begins in 2013 when the Australian Treasury enlisted PwC partner Peter Collins to provide expert advice on new laws aimed at combating multinational tax avoidance. Collins signed a confidentiality agreement as he participated in a base erosion and profit shifting BEPS tax advisory group. During this time, he attended several confidential briefings crucial to developing Australia's anti-avoidance tax laws. Fast forward to 2015, Australia enacted the Multinational Anti-Avoidance Law (MAAL) effective from 1st January 2016. This legislation was designed to prevent multinational companies from shifting profits offshore to evade taxes. Collins, in his advisory capacity, had access to confidential information about the law's structure and implementation. In 2016, after only a few weeks from the passing of the MAAL, the Australian Tax Office ATO noticed that several MNCs had very hastily and suspiciously reorganized their operations and quickly issued directives for these corporations to revise their structures, foiling their plans. Between 2017 and 2019, the ATO collected thousands of pages of information from various firms, including internal emails from PwC staff. These documents suggested a concerted effort within PwC to leverage confidential insights from the Treasury to attract clients seeking to minimize their tax liabilities in Australia. The investigation continued in 2018 with the ATO raising its concerns with the Treasury, but was limited by secrecy provisions from fully disclosing the issues. Later in March, the ATO took this information to the Australian Federal Police, AFP. However, by 2019, both the AFP and ATO concluded that they lacked sufficient evidence to proceed with a criminal investigation against Collins. The ATO then attempted to apply promoter penalty laws intended to deter the promotion of tax avoidance schemes, but faced challenges in doing so. In July 2020, the ATO finally referred Collins to the Tax Practitioners Board, TPB, for investigation. In 2021, the TPB began its investigation into Collins and subsequently launched a separate investigation on PwC. On 23 December 2022, the TPB terminated Collins' registration as a tax agent and barred him from reapplying for 2 years. The board harshly criticized him for exploiting insider information for PwC's benefits and failing to manage conflicts of interest, thereby breaching professional codes of conduct. At this point, the scandal was still relatively contained within regulatory circles, and the government had accepted PwC's assurances that the issue was limited to a single rogue individual. However, on 2nd May, the Senate released PwC's internal emails to the public. It became evident that the problem was more widespread than initially portrayed. The emails, spanning 144 pages and involving at least 50 individuals, revealed that multiple colleagues were aware of, and in some cases encouraged Collins' sharing of confidential information. This sparked widespread public outrage. Following these revelations, PwC Australia's CEO Tom Seymour resigned, and 9 partners were stood down. The AFP also initiated a criminal investigation into PwC's conduct, focusing on potential breaches of confidentiality and fraud. In June, under mounting pressure, PwC issued public apologies and committed to cooperating with regulatory authorities. The firm disclosed the name of 63 staff and partners involved in the scandal to demonstrate transparency and accountability. And finally, in a significant move, PwC sold its government consulting business in Australia to illegal funds for $1 Australian. This step was aimed at separating the firm from the misconduct. Meanwhile, numerous clients, including government agencies and major corporations, suspended or terminated their contracts with PwC Australia, leading to substantial financial and reputational damage. The PwC Australia tax scandal's consequences continue to be felt to today and prompts us to find out what exactly were the ethical issues involved and how did these ethical breaches become so deeply embedded.
Next, I'll be discussing the key ethical issues relating to the PwC scandal, conflict of interest and professional duty, and how they are related to the different stakeholders, which are namely Collins, his colleagues, PwC leaders, and PwC company itself. First, Let's take a look at the conflict of interest. A conflict of interest arises when a person's personal, financial, or other interests could potentially interfere with his professional judgment, objectivity, or duties. In this case, Collins had a unique position as he participated in confidential consultations with the Australian Treasury, where he was responsible for designing new laws to tackle multinational tax avoidance. As a result, he had a duty to maintain confidentiality and prioritize the public interest. However, he was also advising private clients at PwC on ways to minimize their tax liability. Then, let's look at the conflict of interest faced by PwC Australia. PwC operated in two roles. The consultation division provided advisory services to the government, including confidential policy development. Concurrently, PwC's tax advisory division was advising multinational corporations on minimizing their tax liabilities. This dual role led to an inherent conflict of interest. From PwC's actions, we can infer that they prioritize short-term competitive advantages over long-term reputation and ethical consideration. In addition to the conflict of interest, Collins and his colleagues breached their professional duty. According to the Code of Professional Conduct under the Tax Agent Service Act 2009, Collins was obligated to keep any government information confidential. However, he shared insider information, prioritizing personal and corporate gain over his professional and ethical obligations to the Australian Treasury. Finally, PwC's leadership also failed to uphold their professional responsibilities. As leaders, the CEO and Board of Directors owe a duty of care to PwC. In this case, they failed to prevent or address Collins' misuse of confidential information and did not hold him accountable for the leak. Moreover, the leaders did not ensure that client confidential information was safeguarded, indicating inadequate corporate governance within PwC. There is also an ethical concern over PwC's marketing approach, as clients were pressured to sign up for PwC tax services and breach the trust inherent in advisory relationships.
Next, let's discuss the ethical theories and concepts for evaluating the decision-making and actions of the stakeholders involved in the scandal. There are three primary ethical frameworks: utilitarianism, principle-based, and virtue ethics. We will also be using the marketing framework to evaluate the marketing strategy of PwC. Based on utilitarianism, PwC and 14 US companies benefited in the short term. PwC was able to get a commercial gain of $2.5 million, while the 14 US companies could potentially reduce tax liabilities. However, the leak also caused short-term harm where there is inefficiency in tax law development, which could potentially result in lower tax collection. More importantly, PwC is actually negatively impacted in the long term despite benefiting in the short term. PwC suffered severe reputational damage, losing its federal government client and selling its Australian government consulting business for just $1. This resulted in an $820 million revenue loss and a drop to third place behind Deloitte and EY. PwC employees were also affected, with partners taking a 30% income cut and 329 jobs eliminated as of March 2024. Overall, it is pretty obvious that the negative impacts affect more stakeholders at a greater extent. As such, based on utilitarianism, the action of leaking confidential information for commercial gain is unethical since it resulted in a greater overall harm than good. According to principle-based ethics, Collins holds three primary responsibilities as a tax advisor, a PwC employee, and an accountant. First, he breached his duty as a tax advisor by leaking confidential information. Second, he violated his obligations as a PwC employee by compromising the trust between PwC and the government. He neglected his responsibilities as an accountant by failing to uphold integrity and objectivity, acting dishonestly, and engaging in a conflict of interest. Other PwC employees held two key responsibilities as PwC employees and as accountants. They violated both by failing to report Collins' unethical actions, even though they recognized them. By remaining silent, they disregarded PwC's code of conduct and failed to uphold the integrity expected of them as accountants. According to principle-based ethics, Collins and his colleagues acted unethically as their actions were driven by self-interest rather than their professional responsibilities. From a libertarian perspective, Collins' decision to leak confidential information for commercial gain might be seen as justifiable, as libertarianism advocates for individual liberty, which in a business context often translates to the right to pursue profit with minimal restrictions. However, from an egalitarian standpoint, Collins' actions will be considered unethical, as his use of insider information for competitive advantage disrupts a level playing field among the Big Four accounting firms. In terms of virtue ethics, Collins' actions reveal a lack of honesty, trustworthiness, and respect for confidentiality. Similarly, other PwC employees demonstrated a lack of integrity and responsibility by remaining silent, failing to prevent and even praising Collins' actions. Next, we will evaluate the ethicality of PwC's marketing strategy using the marketing framework. Regarding the voluntariness of the exchange, PwC set deadlines to create a sense of urgency for clients to proceed. However, since clients have the option to work with other Big Four firms, the exchange can be considered voluntary. In terms of informed decision making, clients were unaware that PwC was leveraging confidential information in its advisory process, meaning the decisions were based on incomplete information. As for the client's actual benefits, although they could have gained from the transaction, their reputations have been damaged as they are now perceived as companies attempting to avoid taxes. In conclusion, PwC's marketing strategy was unethical due to a client's uninformed decision making and their lack of true benefit from the exchange.
Next, let's discuss the alternative actions by stakeholders, Collins, other PwC employees, and ATO respectively. First, let's look at Collins' possible alternative actions. Upon his appointment as a member of the Base Erosions and Profit Shifting Tax Advisory Group, Collins could have immediately declared a conflict of interest and removed himself from decision making. We'll break down into three perspectives: utilitarianism, principle-based ethics, and virtue ethics. Utilitarian view, by avoiding this dual role, Collins could have prevented all short and long-term consequences, which were mentioned previously. In terms of principle-based ethics, Collins could have fulfilled duties and uphold professional standards expected from him. Virtue ethics suggests that Collins could have shown integrity and responsibility, making the moral, courageous choice to do the right thing. Other PwC employees who knew about the unethical practices could have used PwC's internal whistleblowing policies to report Collins' action. Alternatively, external reporting to government authorities is also applicable in this case. Well, from a utilitarian perspective, effectiveness of internal reporting is questionable due to the involvement of other partners. Reporting to government authorities might be more effective as it addresses the problem as early as possible. However, the whistleblower could have faced repercussions within PwC, potentially impacting their career. Based ethics. Whistleblowing would have demonstrated a strict adherence to professional standards and PwC's code of conduct. From a virtuous perspective, external reporting to the government is an uncompromising commitment. But the reporters may be seen as disloyal to the company. Turning to the ATO, as the regulatory authority, could have implemented sanctions and acted more decisively upon learning the scandal in 2017. Utilitarian perspective, this would have minimized the consequence to PwC, the government, and the public. However, this may also set a precedent of overlooking due process. From the perspective of principle-based ethics, bypassing established protocols is unethical as it undermines procedural integrity. However, virtue ethics will recognize ATO's early investigation as it demonstrates courage in prioritizing the public good. However, there are concerns about integrity risk if the ATO were to disregard due process. Combining all three perspectives, the most ideal scenario would have been for Collins to declare his conflict of interest from the very beginning. This action would have resulted in the best outcome for the greatest number of people. Alternatively, if Collins failed to act ethically, PwC employees could have addressed the issue early by attempting internal whistleblowing, and if that proved ineffective, resorting to external whistleblowing. ATO could also have conducted a deeper investigation to expose the scandal earlier.
By examining stakeholder motivations, we can analyze how various factors influence their behavior. We will focus on PwC's internal stakeholders and the ATO. In 2023, an independent review by Switkowski revealed significant governance and cultural issues within PwC Australia. The structure of PwC Australia's Board of Partners created a lack of independence and impartiality due to its domination by internal partners with deep-rooted connections within the firm. Challenging senior figures was made difficult and actively discouraged. This lack of accountability led to oversights in fundamental processes and may have directly contributed to Collins' actions. Furthermore, the firm's decentralized operating model allowed individual business units substantial autonomy, leading to fragmented decision-making and a lack of coordinated oversight across its overall operations. This weakened the firm's risk management framework and significantly limited the Board of Partners' ability to implement cohesive governance across PwC. There was a failure to track confidentiality commitments and an over-reliance on individual partners to adhere to ethical standards without adequate oversight. As a result, Partners who are not privy to the confidential information were unable to hold unethical partners accountable. PwC's aggressive growth culture further reinforced these issues, where revenue was king. High revenue generating partners often operated beyond the usual rules. Unethical behavior was thus either overlooked or tolerated by others if they contributed to financial success. Employees may have found that engaging in such misconduct was not only acceptable, but also aligned with the firm's overarching goals of maximizing profit. PwC's culture was also overly collegial, with a high degree of trust among partners. There was an increased focus on fostering relationships among long-serving partners and promoting a good news culture that stifled any form of criticism. This culture of harmony often led to tolerance for unethical behaviors. Next, ATO's handling of the situation also drew public scrutiny. ATO chose to refer only Collins to the TPB, and when they expanded the inquiry to cover PwC, ATO stopped supplying any more documentation. Limiting blame to Collins contained immediate reputational damage, especially as publicizing PwC's involvement in aiding tax avoidance among multinationals might have compromised the integrity of the whole Australian tax system. However, the approach raised concerns about ATO's relationship with the Big Four, which would weaken public confidence and trust in the government and its systems.
Thus arises the need for an effective proposal to deal with such ethical challenges. To build a truly ethical culture at PwC Australia, where we focus on embedding core values and principles that guide not only our interactions with each other, but also our engagements with clients and stakeholders. Our goal is for employees to act responsibly even beyond legal requirements, minimizing risks and reducing costs associated with unethical practices. In short, a strong ethical culture directly supports both compliance and the bottom line. Leadership at PwC has a unique role in establishing a culture of ethics. This starts with setting a clear ethical tone from the top, where leaders demonstrate the values we uphold through their own actions. We see effective examples of this kind of leadership worldwide, such as Unilever's CEO, who prioritizes sustainable practices even if it impacts short-term profits. Such leadership reinforces our ethical culture by showing that integrity is non-negotiable. Positive reinforcement is a powerful way to build and maintain ethical behavior. Recognizing and rewarding ethical actions strengthens morale and commitment to these values. Programs like Microsoft's Integrity at Microsoft, where employee bonuses are tied to ethical conduct, provide a model for encouraging integrity. At PwC, adopting a similar approach could reinforce the real benefits of acting ethically, making it clear that integrity aligns with personal and company success. Next, while positive reinforcement is essential, accountability must also be maintained. A compliance-based approach where unethical behavior is swiftly addressed through disciplinary measures like demotions or terminations underscores our commitment to ethics. For instance, Lucent Technologies' swift response to unethical conduct in China sent a clear message about their ethical priorities. At PwC, we can build a culture where employees understand that unethical actions carry real consequences, reinforcing integrity throughout the organization. Finally, regular ethics training is critical in ensuring employees have the tools to recognize and respond to ethical challenges. Programs that address legal obligations, ethical decision-making, and real-life dilemmas, as seen in Deloitte's comprehensive ethics training, help foster a more ethically aware and responsible workforce. By prioritizing regular training, PwC can cultivate a workforce well-equipped to make ethical decisions, strengthening our overall ethical culture.
Now we'll be looking into 3 corporate governance reforms designed to strengthen PwC Australia's framework and address ethical challenges head-on. At its core, corporate governance is about how we manage our organization, ensuring accountability, fairness, and transparency with our stakeholders to promote long-term sustainability. First, let's look at the importance of decentralized internal and external audits. A decentralized internal audit structure involves assigning different auditors to monitor specific departments closely. This approach allows for a more detailed assessment of internal controls, risk management, and policy adherence. Importantly, these internal auditors report directly to a centralized audit committee, maintaining objectivity and avoiding any departmental bias. When employees know their actions are routinely monitored, it fosters a culture of integrity and personal responsibility, aligning them more closely with ethical standards. Internal audits provide early insights into potential compliance gaps and weaknesses, giving the organization a chance to correct issues promptly. External audits, on the other hand, bring an independent perspective. By assessing compliance and ethical practices, external auditors provide recommendations that may reveal areas overlooked internally due to cultural biases or internal pressure. Together, this comprehensive internal and external audit framework can significantly strengthen the organization's accountability. Next is improving conflict of interest policies. Implementing clearly defined, well-communicated, and consistently enforced conflict of interest policies is crucial to preventing ethical breaches. Transparency in handling conflicts is also key to rebuilding public trust and restoring our reputation. Since the responsibility often falls on employees to identify and report potential conflicts, a well-designed policy should support them in recognizing, preventing, or managing conflicts. To help employees better understand what constitutes a conflict, the policy should include relevant industry examples. HSBC, for instance, provides a publicly available conflict of interest policy that clearly outlines how various stakeholder relationships may lead to conflicts, alongside examples and preventive measures. Such clarity is invaluable, particularly in cases where ethical lines may be blurred. Accessibility is also critical. Employees need to be able to consult the policy easily and should be encouraged to do so whenever they are uncertain. To support effective conflict management, companies should establish clear reporting mechanisms and structured guidance to help employees navigate these situations. An internal register can be used to record and evaluate disclosed conflicts, ensuring consistency in handling them. For larger or more complex organizations, a dedicated team or department can assist employees in identifying and resolving conflicts. This not only provides additional support to employees, but also reinforces the organization's commitment to ethical practices. Ultimately, a strong conflict of interest policy empowers employees to act responsibly, building trust within the organization. Finally, fostering a strong whistleblowing environment is key. Many employees are hesitant to report issues due to fears of retaliation, concerns over confidentiality, or skepticism that their reports will be taken seriously. To overcome these barriers, companies must respond to whistleblowing reports promptly and decisively. Swift responses show that the organization takes ethical issues seriously and is committed to addressing them. To ensure confidentiality and support a safe environment for reporting, an independent third-party reporting portal can be implemented, allowing employees to report concerns anonymously. Adding on to that, anti-retaliation measures, which protect whistleblowers from demotion or mistreatment, are essential to building trust in the reporting system. Microsoft, for example, has a dedicated whistleblowing portal with strict protections, a model that PwC Australia could follow to ensure ethical issues are resolved before they escalate. By implementing these corporate governance reforms, PwC Australia can create a culture of accountability, transparency, and integrity to build a more resilient organization.
To conclude, the effects of the PwC Australian Tax Scandal continue to be felt till today as investigations are still ongoing. This significant case study demonstrates the ethical challenges that arise from conflict of interest, breaches of confidentiality, and deficiencies in corporate governance. We use multiple frameworks to evaluate the ethicality of the key ethical issues, as well as evaluate the impacts of various stakeholders' action. We also discuss how there is a need for proactive measures and adherence to ethical principles, ensuring integrity across PwC's practices. In a profession where trust is crucial, the PwC scandal underscores the critical need for organizations to uphold ethical standards and prioritize public interest over profit, as failing to do so risks severe financial, reputational, and societal consequences.